So, Mike, thanks so much for joining us this morning. Let's continue where we left off a little bit last week and really continuing some of the further details around the Canadian Pacific situation.
Yeah, the Canadian Pacific, there was just a environmental impact draft released, I think just this morning that I haven't had a chance to go through yet from the Surface Transportation Board. What I wanted to go through this morning, I think I have a couple of SONAR charts, loaded up, is really talking about the results that Hub Group reported last week, and we thought it would be helpful to talk about how those relate to what we're seeing in SONAR. So if you want to put up this first chart on domestic container volume. So this is, domestic intermodal volume. So these are 53-foot containers, which is really that core market that Hub Group, J.B. Hunt, Schneider compete in. And the first quarter, I have it up about 2.5%, year over year. And I guess in the second quarter, it's about 2.5%. Heard from Hub Group last week, they were up about 1% in their second quarter volume. So a little bit of underperformance, but not much. Really intermodal in the third quarter seems to be tracking up about 5% on the domestic side year over year. And you sort of were getting into this period where we're lapping sort of an easy comp with last year. Remember last year in the third quarter, there were all those congestion issues and sort of equipment shortages, not having enough chassis, not having enough draymen. Some of those have eased a little bit. Still sort of rail service, not where a domestic intermodal company like Hub Group would like it, or where a Class 1 railroad, would like it. So, Hub Group is saying they're expecting low single-digit volume growth for the full year. So not a lot of volume growth there. I think it sort of remains to be seen whether we see a significant peak season at the end of this year, like you have the last few years. I think that's still kind of an open question. This next SONAR chart I have really sort of speaks to why these domestic intermodal companies have been performing well, posting strong financial results. And these are contract rates. This is a nationwide average of domestic intermodal contract rates. And you see 2022 there in blue, up double digits over 2021. And those were up double digits over 2020. And even though the domestic freight markets have weakened some, most of those contracts were renegotiated earlier in this year. They are going to face a tougher comparison later in this year. You see in the orange line how that got progressively higher throughout last year. That's not going to happen this year. If anything, this year it's going to be flat, going forward, maybe even down. But I think when you get into next year, you'll start to see some negative year-over-year comps in intermodal, contract rates, given that the freight markets have gotten to be more competitive. But for time being, the domestic intermodal companies are really reporting strong results, because these contract rates that have been set, they're still taking advantage of them. Hub Group had a whopping 44% increase in revenue per load in their second quarter. Now, about 12% of that was pure price. The rest of it was sort of fuel and mix because there's more of the longer length of haul, which I can talk about here, in a second. On this next chart, I have, shows Chicago to Atlanta, if you want to bring this up. And this is really part of the reason why their length of haul went up as much as it did, why there was a positive mix impact, and why there was a volume decline in what they call the local east lanes, which are lanes that originate and terminate sort of, let's say, Chicago and points east. They said it was about 14% decline in local east volume. And you can see what we have here is these are truck stop rates between Chicago and Atlanta in blue. Basically, the bottom's sort of fallen out, went from $4 earlier this year to $2.45. When you look at what we have in track, it's down at $2.13. And I use truck stop here just to sort of easily compare it to these intermodal spot rates. Now, not a lot of intermodal volume moves on the spot market, but it's kind of telling that the carriers have kept those rates high up there at $3.76. It sort of suggests that they're trying to protect as much capacity as possible for those contracted shippers, which suggests that service is not great in the eastern part of the country in that sort of core lane, Chicago to Atlanta. So really, intermodal, in short, very competitive in the eastern part of the country. We saw that in the decline in the local east volume. It's more insulated in those western sort of traditional longer haul routes, like a Chicago to or LA to Chicago and back, LA to Dallas and back. So companies are still performing well based on having strong rates that are in place, at least for now.
And so, Mike, when we talk about this, we know that for a while back when the truckload sector was just so heavy with delays and when things were just really kind of struggling, there was this massive backlog of freight on the truck volume side. A lot of people were touting intermodal as the release valve and saying, you know what, we're going to move goods to intermodal. They're going to keep moving. And now we're seeing that it's kind of, we pushed the problem onto the rails and now it's having that same congestion issue. Is there a place where now the problem gets pushed other than the rails, and or do we see just kind of the tangle of intermodal kind of slowly start to unravel itself?
Yeah, so I've always thought it was kind of a misnomer that the intermodal is a relief valve for trucking, and really that's because it's so concentrated in these heavy lanes that are anchored by big cities, and they don't, intermodal doesn't go everywhere. It's really only competitive in few lanes. So I never really thought it was a huge relief valve. I mean, I think it benefited some from having imports that got to be less time sensitive because with inventories being as high as they are. And so now I think it's a little bit of, sort of the key question is how time sensitive are the goods? I mean, if there's already a lot of similar products in inventories closer to consumption centers, then it doesn't really matter that so many of these containers and imports are waiting at the ports for 9 days or longer. But at the same time, I mean, not everything has a lot in inventory, and truckload is very competitive, including out of the port near LA and Long Beach, and carriers are only rejecting 5% of tenders right now, including like in lanes like LA to Chicago. So shippers can get those goods moved. It's really, I think they're just deciding how time sensitive are those products.
And real quick, Mike, before we let you go, in terms of goods being moved, are there any commodities jumping out at you right now that's being hauled, or being shipped throughout the rails or intermodal?
Any specific commodities that jump out? I would say that one of the interesting things has been grain. That's grain and potash, I think, have been really in strong demand. I think some of that's been that the crop has been better than it has been. So you're seeing more of that rail carload volume, increase for grain. Those prices are high. That encourages the farmers to get those goods to market.
All right, Mike, thank you for joining us this morning. We'll catch the stock out coming up later on this afternoon. And if folks want to subscribe to your newsletter, where can they go to do that?
It's just freightwaves.com, and then up at the top, there's a list for newsletters, and the first one listed there is the stock out. So please join me with that.
Awesome, Mike. Well, thank you so much for joining us this morning. We'll check in with you again throughout the week. Right now, we're going to go over to our second carrier update of the morning.